You're listening to Mortgage Investing 101, the show where we discuss high yield real estate mortgage backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co host, Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. Our goal is to provide information and to increase your awareness of these important alternative investment strategies where you can earn secured high yields using your savings or IRA accounts. Annual yields of 8% and more are not uncommon using these strategies we're going to discuss in today's show. And if you like what you hear today, please call Pacific Private Money at 415-883-2150. Or for more information, go to pacificprivatemoney.com.
Actually, we're going to give out the new fund website for more information. That's just launched this week. It's pacificmoneyfund.com.
I like that.
pacificmoneyfund.com. Brand new website, chock full of information on mortgage investing.
And you can see what we look like, too. You can also call our hotline, 888-529-1134, and leave your name and question, and we'll get back to you after the show. And for fun, we're going to have trivia contests where we're at commercial breaks. We're giving away to the first three callers with the correct answer a free 3-day, 2-night vacation. And the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. The vacations are free. Lighthouse is only requesting a $75 cleaning fee. Check them out at lighthouse4fun.com. Today's trivia theme is Jim Carrey movies. We'll have some fun with that. Now, Mark, tell us what's new going on in mortgage investing.
Well, Edward, as you know, sitting across from me, I'm suffering from what someone told me was, oh, you have an adrenaline hangover. Because last night we had the Pacific Private Money Fund launch party at Piatti's in Mill Valley. It was a 2-hour, actually it went on for 3 hours last night. We kind of stayed over and hung out with some folks. We had over 100 people show up in a room that had capacity of 100. And now I know when they say the room capacity is 100 or 200, that's
accurate.
That's like you've got maybe a couple of inches around you to work with. It was a pretty crowded event.
No, we got some very good feedback from people on it.
And you know, I really enjoy public speaking. It's I kind of look at it as a challenge. It's stretching. You know, a lot of people talk about the fear of public speaking, and I'm not so much the fear, but every time I speak in front of a large group, in the days leading up to it, of course, I'm practicing and I'm putting the slide deck together, and I want to give a good performance. And I got pretty good reviews for the performance last night, as you did too, Edward. But the next day, I swear, I'm exhausted.
Yeah.
I really am. So my energy level's really low, but I'm going to be a professional and deliver a good show for our listeners today. But again, what we did last night at the Pacific Private Money Fund launch party was really just kind of open up to the public and invite the public to, which included existing and prospective investors in our mortgage pool fund, to come listen in on a detailed presentation of how our fund works, get a chance to meet our staff, because we've got a great staff. We've got 10 people in our company at Pacific Private Money, which is quite a bit considering that most private money loan originators in the Bay Area are small staff businesses. There are really very few companies that have scaled up to the size that we have, and we've got a great staff. And I was really pleased to show them off to our investors and meet face to face some of the folks that have invested quite a bit of their retirement savings into mortgage secured investments with Pacific over the last 5 years.
Oh yeah, you got people investing hundreds of thousands of dollars.
Right, and what's really interesting about it is many of them I have met in person because they've come to visit us at our offices in Marin County and downtown Novato over the years. But it would surprise people surprise the public to know how many people have pulled the trigger and invested hundreds of thousands of dollars in mortgage secured investments, whether you call them trust deeds or private notes, and even our mortgage pool fund,
without ever having met you.
Yeah, without ever actually having looked me in the eye.
Well, I tell you, I think part of it is because what you're offering is fairly simple, pays a high rate of return, and it's secured.
Well, and there is a lot of vetting you can do on people on the internet these days. And one of the things we try to do at Pacific Private Money is be very transparent and sincere in the way we present our company and the opportunity. And so if you go to our website, there's, unlike many websites, We have our local phone number. We have our email addresses. We have our pictures. We have our biographies. I mean, we're very transparent. So you can see who we are and what we're doing. You can go to LinkedIn and find out all about me and my staff, and Facebook. I mean, we've got I like the word ubiquitous. It's one of my favorite word. My favorite word of the week. Word of the day. Yeah, ubiquitous, which is you're seen everywhere, and so.
Yeah, it cracks me up when you look at some of these places and for contact information. There's no phone number, there's no address, there's maybe an email, and it's like, well, I don't feel a little comfortable with this.
I've got most of the California competition that I've met over the years who are also hard money and private money loan originators. I have their websites bookmarked, and I've collected them. I've probably got over 150 hard money lender websites, just California based, and I can't tell you how many of them have an 800 number, no personal email address, no physical address. You gotta wonder if these guys working out of their bedroom? Is it a one-man shop? I mean, who are these people?
Station wagon, driving around the
no
state.
credibility, no transparency, no authenticity involved. So anyway, and no wonder people can be hesitant when it comes to investing in this type of stuff.
Okay, so let's get into the nuts and bolts. The name of the show is called Mortgage Investing 101 with Edward Brown and Mark Hahn. And the listening audience,
2 seasoned hard money loan originators. You've been doing this for 20 years. I've been in real estate for 30 years, but originating hard money loans for the past 5 years. So yeah, the nuts and bolts of it.
Nuts and bolts.
Right.
Okay.
What is mortgage investing?
Yeah.
Well, mortgage investing is another name for an alternative investment strategy where you can earn yields of 8% or more that are secured by real estate. And in the case of Pacific Private Money, it's secured by Northern California, largely, real estate. I mean, we can lend anywhere in California, but we mostly lend in Northern California. The loans we make are to real estate investors who are buying, fixing, and flipping real estate. Mostly. Mostly. Yeah. There are other situations. Sometimes we'll do short-term loans on an owner-occupied purchase. We do a lot of small commercial and multifamily as well, but probably the strongest demand for capital today that we see day in and day out are rehabbers, contractors, real estate investors, flippers, whatever you want to call them, calling us up and saying, hey, I'm buying a short sale, or hey, I'm buying an REO, or I'm in contract and I have to close by next Friday. Can I get a loan from you to help me buy this property?
And this is primarily because of the meltdown that we saw in 2007.
This is primarily because you're right. Yeah, the banks no longer serve the market of real estate investor capital needs. You may not have known that. In fact, many people don't believe that when I tell them. They think, oh, of course they are. No, they're not. They literally just turned off the faucet in 2008, where they were, prior to that, making loans to anybody, liar loans, right? They were called.
Oh, yeah.
You can, stated income, stated assets, SISA. Whatever you say goes. Fill out the uniform residential loan application with any number you want. Just make it up, and you too can buy income property, 100% financed.
Well, a good backing up of that story there is, or actually backing that up, is a story that I heard just about a month ago, where a broker was talking to me about the fact that he couldn't believe that a bank would not lend this lady on a fourplex in a good area. She had 50% down payment, and she was buying it, right about market value. It wasn't a big discount. It was 4 units that were producing it, real plain vanilla. And the reason they wouldn't lend her is because it had been 10 years since she had owned rental real estate. So she used to be in the real estate rental business, but she hadn't done it for 10 years. And so they just assumed, well, gee, you haven't been in it for 10 years, maybe you don't know what you're doing anymore, and they decided it was too risky.
When it comes to non-owner occupied real estate loans, I really think that for the most part, banks are looking for a reason to decline the application.
Which is lovely for your company.
Right, which is great for Pacific Private Money.
That's
so to
great.
continue on about mortgage investing, so we originate loans to real estate investors. We generally do fairly conservative loan to purchase price or loan to value originations. We typically don't go higher than 70% of the purchase price, meaning the buyer has to come in with at least a 30% down payment plus the closing costs.
And we got to remind people of that. You're talking about today's market value, which of course a lot of real estate has come back.
Not future value, not 2005 value.
Exactly, that's what I was getting at. Not 2005 value, but of course the funny thing is a lot of real estate has come back quite a bit. But That's important for people to know that you're not dealing with, okay, what was the highest value at the time times 70%. It's what is it today?
Right. So a typical loan request would be they're buying a $200,000 property in Oakland that they want to remodel and flip, and we'll make them a $140,000 loan. They'll come in with the $60,000 down payment plus the closing costs, and they'll provide their own remodel costs, whether it's $25,000 or $50,000. They'll remodel it on their own dime. And typically on these fix and flips, by the time it's remodeled, the value is increased to where our loan exposure is below 50% loan to value.
Okay, now a lot of people, they hear the word Oakland, and immediately their ears are going to turn off. I'm hoping that these are not all East Oakland type properties. I mean, maybe there's some, there's probably Oakland Hills.
There are markets throughout the Bay Area that are in neighborhoods where you might not feel comfortable driving through during the day or night. And there are other markets in virtually every city in the Bay Area where there are, working class, middle class, upper middle class, and Oakland happens to be a city where I believe it has the most single-family homes of any city in the Bay Area. And so there are a tremendous number of neighborhoods where we are very bullish. We love Oakland. We love lending in Oakland. Are there areas of Oakland we tend to pass? Yeah, I'm not a big fan of some of the neighborhoods near the Coliseum area and the flats, as they call them, or the avenues, as some refer to them. But we actually do make loans there as well. Sometimes it's a neighborhood by neighborhood, street by street analysis of what it looks like. What's going on in the neighborhood? Are there a lot of is there a lot of distressed looking homes on the street? So we have to do an analysis. So we tend to be very discriminating, but we don't discriminate when it comes to
I mean, you're doing your due diligence.
Yeah.
You're not just saying, oh, it's 70% of loan to value automatically means a yes. You have to do other kinds of due diligence.
Absolutely.
Tell you what, hold on to that thought. We're going to cut to our first commercial break. When we come back, we're going to get into specifics. The deal of the week, because the listening audience, they hear this, but I think they want to really know, give me specifics on the kinds of loans that you're actually really doing and how I can participate in them. Okay, the theme is Jim Carrey movies. Here's the first commercial break. First trivia question. In which 2003 movie is Bruce Nolan, played by Jim Carrey, given the power of God? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. In which 2003 movie is Bruce Nolan, played by Jim Carrey, given the power of God? Again, we're talking Jim Carrey movies. 888-529-1134. Make sure to include your name and your email address, and speak slowly and spell out your email one letter at a time. Don't touch that dial, because Mortgage Investing 101 with Edward Brown and Mark Hahn will be right back.
Yep.
You know that one?
It kind of went off my brain there. I
Okay.
keep thinking, oh God, and I know that's not it.
No,
It's
yeah.
got Morgan Freeman in there
That's
as
right.
the big guy, and
That's the big guy. The big kahuna.
that's right. But I forget him in the movie. So
Any specific deal of the week?
we may just want to go back just to kind of finish the conversation of what is mortgage investing. 'Cause I don't think we quite got to, and again,
That's
just
true.
thinking about a new listener, first time listener,
Yeah.
we get a chance to say, how do you participate? So how do we use private money? How do we use your money to provide those returns? What kind of security do you have? So let's talk about that a little bit, and then ask me about a deal of the week, and maybe I'll talk about there's an Oakland Hills project that contractor needs to sell. He's run out of money in order to complete. We're going to buy it at a discount.
Okay. Excuse me. Ah. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with my co-host, Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. He is the expert. By the way, Mark can be reached at 415-883-2150 for any questions regarding hard money real estate loans or investing in mortgage investments. And our first commercial break trivia question the theme is Jim Carrey movies. In which 2003 movie is Bruce Nolan, played by Jim Carrey, given the power of God? Now, originally, what movie did you think it was?
I thought it was Oh God, but
No.
it's at the tip of my brain.
Now, what did I say? What was the character's name? Bruce Nolan?
Bruce Nolan.
Hint?
Bruce Almighty.
Bruce
that's
Almighty.
It. Yes.
There you go. Okay, you remember Morgan Freeman and all that. Okay, before we actually get into the deal of the week, let's kind of finish up on exactly the mortgage investing, what it is, how can the listeners participate?
So we talk about our business model at Pacific Private Money and other hard money and private money loan originators is that we make loans to real estate investors. Okay, so the source of the capital that we use to make those loans are from private individuals like you. And so we have individuals who invest in our notes or our mortgage pool fund either through their personal savings or through their trust accounts or even through their self-directed IRA accounts. Very popular method of getting high yields is to use your self-directed IRA account to invest in, say, a mortgage pool fund or an individual note. And the reason why self-directed IRAs are popular for that is that you really can't use any other IRA type or retirement account or 401k that's not self-directed, because when we talk about mortgage investments like trust deeds, like private notes, like mortgage pool funds, these are in the class of alternative investments, meaning that these are not readily liquid, over-the-counter, traded daily like stocks. These are syndications that are regulated by the state of California or by the federal government, by the SEC, but they are a mortgage pool fund. You're a shareholder of the fund, and so it is not something that's readily tradable. Now, you can sell your shares. They are liquid. There are markets that exist where you can sell your investments in a deed of trust or other notes. So it's not like your money is locked in per se, but it's not like the stock market where if you buy Apple shares, you can turn around and sell them tomorrow.
Except that in the fund, though, there's also the potential. I mean, let's say if I own shares in the fund, I don't have to go out and find a new investor. I can actually get out after 2 years without any penalty.
Well, absolutely. Most mortgage pool funds have no fees for redemption after a certain period. So in our specific fund, we ask that you keep your money in for 2 years. Well, I got a question last night at the party. Well, what if I have to get my money out in a year? What then? Well, then there is a penalty for early withdrawal. It's not a huge penalty, but there is a penalty. And our PPM, our private placement memorandum, does speak about the penalty for early withdrawal. But it's designed to be a no load and no fee investment.
And well, here's the funny thing is your last quarter's distribution was 8.9% annualized.
Yes.
So if that were to continue, which there's no reason why it shouldn't at this
Based
point.
on the loans we're making today, we expect to continue to pay to our shareholders between 8.5 and 9%.
Okay, so let's take the 8.9 because that's what you did. That's actual what you really did pay.
Yes.
And let's say that let's say I'm that investor from last night who says, "Gosh, what happens if I get out after a year? The penalty in exactly 1 year is how much? 5%?
It's 5% the first 6 months, then 4% in the second 6 months. So it
Okay,
goes
so
down
4.
over time. So
Okay.
by the time you get to the last 6 months, let's say month 18 through 24, you're at a 2%.
Okay, but let's so after a year it's 4%.
Yeah.
Well, if I got paid 8.9% and I had to pay this penalty of 4%, I'm still left with 4.9%. That's
Doesn't
still
mean
better
you
than the
lost
bank.
money. Right. That's exactly that's exactly right. It's still better than the bank. So while we don't want our investors to treat our mortgage pool fund like a money market account, it's designed to be a business where we're making loans of anywhere from 6 to 12 to 24 month terms. The fact of the matter is you're not going to lose money via early withdrawal. You're just not going to get the yield that we're bragging about, and we do brag about it. Where else can you earn 8% or more secured with protective equity, low LTV or conservative LTV loans? It's also to a certain degree insured, and it's insured because every loan we make is done through a national title company. There is a lender's title insurance policy issued to the lender, whether it's the fund or whether it's the individual person through an individual note. And there's also hazard insurance required that the borrower has to pay for on every loan we make, covering the collateral, covering the home and it names the lender as an additional insured under the mortgagee clause. So what that means, if the house burns down, we get paid and we're in control of that money to rebuild that house.
Okay, so it sounds like to me, really the big risk is if the market value of the collateral, in this case, let's say a single family house, goes below 70% and you have to foreclose.
That's exactly
70%
right.
of the market value.
So really, a lot of things have to go wrong for your capital to be at risk in today's market of private lending. And so I believe that there's never been a better time than right now, than 2013, and looking ahead to 2014. It sure looks like it's going to be as good, if not better, than 2013. There's just never been a better time to invest in these types of mortgage-backed investments.
It's funny because that sounds like, a sales tool. But here's the funny thing is because I've been doing hard money loans for 20 years, I tend to agree with you. The other time that was a great time to invest was back in the very early 90s during the S&L crisis when the loans, you could be Bill Gates and they wouldn't have lent you any money.
The banks.
The banks, yeah. And the time that it was still, business was good, but not as good. It didn't mean we lost money, but it just meant it wasn't as good. Was, the year 1999, 2000, when, like you said, anybody could just lie or loan, get money from the bank. Here's the deal, though, is that banks have curtailed their lending, and it looks like it's getting more restrictive, not less restrictive, which is great for you.
So we're creating an investment tool for the public that pays them 8% or more on their savings safely and securely. The vehicle that we use are mortgages. They're loans secured by mortgages or deeds of trust on local property. Now, we all know what's happened in the last year. We hit the bottom of the real estate market sometime in 10, 11, 12, and it bounced along for a little bit. Now it's 13. Now in the last 12 months, if you read the newspapers, depending on where you live in the United States, real estate prices in the last 12 months, and this is through August of 2013, the numbers have been out now for a couple of weeks. Depending on where you live in the United States, real estate prices have gone up anywhere from 10 to 25%. I think the highest was Las Vegas and Phoenix. There were markets.
Well, those ones got hit the hardest. Yeah.
But so some have asked me, and we get this question a lot: is are we in another bubble? Well, I've got an article that I printed out and was studying this morning that talks about the fact that Case-Shiller, which is one of the leading tracking companies for various economic indices, including real estate, predicts that we will not see a continuation of double-digit inflation in real estate. In fact, they predict that over the next 5 years, real estate is going to increase on average 3.5% annually.
So relatively flat compared to what it is now, but not going down.
Right. If that number holds true, me as a real estate investor personally, I am thrilled at the idea looking ahead that real estate will go back to the good old days of slow and steady appreciation. Even though a lot of us made money in the run-up of the market, where in the Bay Area from 2000 to 2005, we were having annual 15 to 20% appreciation rates. It's scary it's not sustainable.
Yeah.
That was a true bubble, and I don't want to see the bubble come back.
It's the same thing with the dot-com.
Right.
It turned into the dot-bomb.
Exactly. And so what I'm saying to the listeners is that don't be afraid of what's happened in the last 12 months. The double-digit run-up in real estate prices in the last 12 months are a result of a rubber band effect. It's in the stock market they have a term dead cat bounce, and it doesn't really apply in this case. It's the rubber band effect of the fact that real estate prices in many markets fell substantially below replacement cost, and that is not an economically sustainable event. Housing could not stay below replacement cost, so we've had a bounce back in many cases to be at or now above, again, replacement costs, and that's good for the market. Now, I just don't see that there's any economic foundation to support continuing double-digit inflation because we've got,
unemployment is still.
There's still a job. There's still a constraints on income. There's constraints on jobs. So I like I believe that when I read the Case-Shiller Index, I think the evidence would support the fact that going forward in 14, 15, 16, that we should see a much flatter, much more sustainable and predictable, but slow value increase. Now, does that mean that we won't possibly see a softening or even a slight decline in real estate prices? No.
No, there's going to be areas.
It could happen, and here's what could happen. If mortgage rates, which are now bank mortgage rates, that is for home buyers, because our flipper clients, the exit strategy is they want to sell to a end buyer. They want to sell to a homeowner who's going to come in and buy that house from them. So their profit incentive is based on the fact that they believe they can buy a house, remodel it, add value, and sell it for a profit. So if mortgage rates go from what's now 4.5 to 4.75 to, let's say, 6, which it's not expected to do in the next couple of years, by the way, but if it were, and it happened relatively quickly because of some national or worldwide event that is unexpected, that could cause real estate, I think, in my opinion, to go down 5, maybe 10%, but it's not going to go down the 25, 30% that we saw it go down from 2007 to 2010.
Well, and the reason it went down that 25 and 30% is because the bubble of wire loans pushed it up too high.
Absolutely. So anyway, just to get back and kind of, what's the moral of the story as we started out in this segment is the instrument that we use to produce 8% and higher returns for our investors are real estate secured loans at conservative loan to values in the San Francisco Bay Area, because that's the market that we at Pacific Private Money know and understand. Now, it was interesting, at last night's event, like I said, there was 100 people that showed up to our event. I happen to know from, the RSVPs and who showed up at that event, there were retired real estate professionals, there were people who were active real estate investors, and then there were people
attorneys.
And then there were people who probably weren't real estate investors at all, and quite frankly, probably couldn't care less about real estate. They're just there because they're intrigued by the returns. So you don't have to love real estate to participate in mortgage-backed investments. In fact, there's no need for you to have any appreciation for real estate, but you do need to have a thorough understanding of why we believe these are some of the safest and securest methods of obtaining high yields that are available in the market today. I don't know of any other instrument that comes close to what we...
No, not for the safety and security.
Yeah.
And then here's the thing, is if house prices go, or real estate goes up only 3%, that doesn't really affect you at all. You're 70% loan to value at the most, and as long as it doesn't go down 30% and the borrower defaults. Sometimes prices go down 30%, but the borrower thinks it's going to go back up, and they still make their mortgage payment.
Right.
You're the bank.
It still doesn't mean that the fund is going to go into a non-performance mode.
No.
In fact, you're right. Two things have to happen. The market has to change dramatically downward, and the borrower has to stop making the payments.
Yeah, I mean, there were a lot of people who are underwater, and yet, meaning that their mortgage is higher than the value of the house, and they're still paying the bank. And in this case, you're the bank. That's what we have to make sure that the listener understands. When you invest with Pacific Private Money in the fund, and again, you're talking to Mark Hahn, I'm Edward Brown, and Mark Hahn from Pacific Private Money, and Mark can be reached at 415-883-2150. You're like the bank. You're doing everything that the bank does.
Our loans are identical to bank loans. We use the same type of forms. We use
title insurance.
Right. We use promissory notes and deeds of trust and other supporting documents that are created from industry software that are used by banks all over the nation. We use the same software to produce the same type of legal contracts. We use national title insurance companies. We provide Alta lender title policies. Many of you won't know what that means, but let me just tell you that's the best title policy there is for the lender. And so there's nothing different between a Bank of America generated home loan and one of our loans that we make to real estate investors. So it's the identical type of market.
Okay. Tell you what, we are going to cut to our second commercial break. We did tell the audience that we were going to talk about the deal of the week.
Yeah, let's talk about specific deals in the next segment.
Okay, next segment, because we want the audience to have a clarification as to if they invest with Pacific Private Money, exactly what they're going to be
Right,
investing
what
in.
types of
what
loans
types
do we
loans.
make, and who are the type of people that would borrow money at the type of rates we charge?
Because that's the question.
And why?
Why would someone pay those kind of rates?
Yeah.
Okay, second commercial break, second trivia question. Again, where the theme is Jim Carrey movies. In which 1994 movie Jim Carrey plays a character called Stanley Ipkiss, but his green alter ego says the line, "Smokin'!" The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. In which 1994 movie does Jim Carrey play a character named Stanley Ipkiss, but his green alter ego says the line, "Smokin'"? 888-529-1134. By the way, it's one of my favorite movies. Make sure to include your name, email address, speak slowly, spell out your email one letter at a time. Don't touch that dial because Mortgage Investing 101 with Edward Brown and Mark Hunt will be right back.
Featuring the then unknown actress.
Was she unknown then?
Yeah, pretty much. The
That's what
blonde, what was her
Cameron
name?
Diaz.
Cameron Diaz, that's right.
That's when she had larger breasts. She got them smaller, I think.
Is that right?
Yeah, not too bad, too. That's when she looked the best. Was that her first movie? I mean,
well, it probably wasn't her first movie, but she was not well known until she did that movie.
Definitely got well known after that. Yeah, sorry for having to do the computer thing, but there's a couple little emergencies. It's all right. As long as it doesn't interfere with what you're talking about. It's 17 minutes.
How much?
17.
Okay.
Ready?
Yes.
Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. When we got to the second commercial break, we asked this trivia question. Again, the theme is Jim Carrey movies. Which 1994 movie Jim Carrey plays Stanley Ipkiss, but his green alter ego says the line, "Smokin'"?
Well, I do remember it was a movie featuring the then new actress Cameron Diaz.
That is correct.
I don't think it was her first movie. It was the first time she was ever profiled in a major movie. And I can't remember the name. You gotta give me another hint.
What did he wear? The Mask. That's right. And who can forget the line,
I'm totally.
"Kiss me, my dear, I will reveal my croissant. I will spread your pâté. I will dip my ladle in your vichyssoise."
I love that.
All right,
movie.
Hollywood, get ready to call me to play another Stanley Ipkiss movie. Okay. Okay. So, Mark, we're going to get into specifics now about exactly deals that come across your desk that the fund invests in, that the listening audience, if they're interested in participating, would be able to participate in.
Well, you know, a very common question I get from a lot of people who aren't familiar with our industry, which is the private lending industry as opposed to the banking industry, is why would anyone pay 8, 9, 10% for money, which is what we charge.
Let me ask you that. Why would anybody pay 8, 9, 10% for that money?
Well, the reason they would pay that for the money is because they're in the business of making a profit in real estate. We lend to people who are on the business of investing in real estate, whether they're buying for a long-term hold or if they're buying to add value and then maybe flip the property in 6 months or 12 months, or if they own real estate and they need cash out quickly. So here are the two components really that make the biggest impact on why they come to us for money instead of try to go to the bank. One is speed. We make loans very quickly, and in this market, and this has been true now for a couple of years, speed wins. If you're trying to buy property and you know that you could make a profit on this property, you want to be able to offer the seller a quick close. How do you offer a quick
But
close?
speed doesn't mean someone comes in, asks for money, and 10 minutes later you give them a loan.
Well, no, 5 business days, 10
Okay.
business days, where banks are generally 21 to 30 days. If they like you and
Well, they have to get
like the
appraisal
property.
and all that.
Right, all
So if I understand it correctly, these are people you're lending them money for their opportunity to make more money compared to the guy who comes in and says, "Gee, Mr. Hahn, if you don't lend me money, I'm going to file bankruptcy tomorrow."
No, we do not make distressed borrower loans. And let me just clarify that for a moment. I run into people all the time, and when I tell them what I'm doing, so I'm a broker, I'm a hard money broker, I'm a hard money loan broker, they say, "Oh, you make seconds to people who are in trouble." No. Maybe 20 years ago, there were hard money brokers, and that was their reputation for making seconds to people who couldn't, high-priced, high-fee, high interest rate seconds to people who couldn't afford it. We don't make those loans. We don't lend to distressed borrowers. Let me make that clear. We don't make loans to distressed borrowers. We make loans on distressed real estate because some of the condition of the properties that our clients are buying oftentimes are in sore need of a remodel. Maybe maybe a hoarder lived there, or maybe they're trashed by the previous homeowner or tenant. And oftentimes banks won't make loans on those properties.
But again,
condition.
but the maximum loan will be 70% of whatever that
Right,
condition at the time.
Exactly, we're not making 100% loans to acquire property. We're making 70% of the then value, and so we don't make loans to distressed borrowers. We make loans on distressed property. Now, when I say we don't make loans to distressed borrowers, that doesn't mean their credit isn't shot, because some of my borrower clients still have lower FICO scores because of maybe they let properties go into foreclosure or short sale a few years ago. Right. I mean, it's common that a contractor or real estate professional who applies to Pacific Private Lending for a loan, I pull their credit and I see a bunch of derogatories from 2010 or 2011 because they let properties go. Now, does that mean they're not a good credit risk, that they don't know what they're doing, that they're not a professional real estate investor with experience buying, fixing, and flipping properties in the last few years? Not at all.
No, in fact, in some cases, they probably got advice to purposely not pay, even though they had the ability to pay on those old credit cards or the home loan or whatever.
That's true. Well, let's be frank. How many people do you know who decided they were going to be a hero and they were going to take the moral high ground and keep making payments month after month after month after month on property they bought at the height of the market, which many people bought in 2005 and 2006, and got stuck holding properties that went down in value 30, 50%? I mean, really?
So some of them, yeah. Well, interesting. I mean, I try not to judge these people, but I listen to them, and I'd hear stories about, I haven't made a mortgage payment in a year. Bank hasn't kicked me out, and I'm saving all that money to go buy another property.
Right, and those are homeowners. Again, we don't generally make homeowner loans. We're generally serving the market that the banks are no longer serving, which is real estate investors. So real estate investors will pay 10% for a hard money loan to help them buy property that they believe they can buy, fix, and flip at a profit. We look at their budget, we look at their assumptions. We turn down loans to people whose numbers don't make sense. We're not going to make a loan to somebody and charge them 10% and factor in how many months it's going to take them, whether it's 6 months or 12 months to flip this property. I mean, we're looking at all of these numbers, and if it looks like they're getting themselves possibly into trouble, I mean, if someone looks like they're digging themselves into a hole, we're not going to sell them a shovel.
Okay. Okay. Well, here, the proof is in the pudding. How many loans have you done in the last 5 years?
Over 600.
How many of those have had problems? Call it problems, i.e. going into default. But I mean, I don't care what happened to the property. As long as they made the payments to you, you didn't really care that much.
So we have a 2% default rate in our business, which is actually really low.
I think the bank is like, what, 5%? They assume 5% of their loans are going to go bad? Of course, the taxpayers bail them out.
It changes year in and year out. Of course, I don't know if there's what their percentages are now, but so we've had approximately out of those 600 plus loans, we've had around a dozen loans where we actually physically had to file notice of default, which is the same thing as filing foreclosure. a notice of default starts the foreclosure process. But of those, we have only had, I believe, a total of 5 properties that were physically foreclosed. It went to the trustee's sale, and it was basically foreclosed on and bought back by the lender. And so in each of those cases, the lender made out better.
Okay, so nobody's ever lost money.
So no one's ever lost
Okay,
money.
now,
foreclosure
you know what,
company.
okay, we're gonna stop teasing the audience, we're gonna get into specifics now. Give us a specific deal that you're working on.
Absolutely. I mean, I can
The
give
one
you a
you
whole,
just closed.
right.
Yeah.
So what we're working on now, we're going to close it next week. This is this is a repeat borrower client. He came to us with a property in the Oakland Hills that he has in contract for $420,000. We propose to make him a 70% acquisition loan. The property is like 95% remodeled, and the contractor who's remodeling it ran out of money, got into trouble, and needs to sell quickly. And my borrower slash buyer was able to negotiate this $420,000 price. We did a BPO and
Which means,
broker price opinion, which is really a form of appraisal.
Yeah.
Which is, so we use a company that provides appraisal services for us, and they went and looked at comps, including the house right next door, which is virtually identical and sold earlier this year. And the comparable value is $600,000. Now, does that mean that the house is worth $600,000 today? No, it's almost worth $600,000 because we said it was 95% complete. There's still some trim work to be done and appliances to be installed, etc. But that's a pretty nice discount that our buyer is getting.
no issues with mechanics liens?
No, we were able to determine that the mechanics lien issue was not an
Okay.
exposure. And oftentimes it is in situations like this, but we're able to get title insurance insuring first position in front of any unknown mechanics liens. If it's known mechanics lien, of course, we just have the seller pay it off.
Yeah.
So anyway, so that's one. And again,
What's
in
the
the
term?
Oakland Hills, the term is we're making a 12-month loan. This one he thinks he's going to flip quickly, so we're offering it at no prepayment penalty. The interest rate on this one is, actually, this one's an 11% loan because of the fact that he is telling us he thinks he's going to sell it quickly.
Oh,
so
yeah, I mean,
we're charging a
whether he-
small premium on the interest.
Yeah, I mean, whether it's 11, 10, 12, 13%, I mean, if he's gonna flip it quickly, it's not gonna cost him that
Right,
much
well, he
more.
hopes to flip it in 90 days.
Yeah,
but
90
more
days.
often than not, it goes to 4 or 5,
Of course,
6
but
months.
he thinks it's only gonna be 90
He
days, so he
thinks it's
says,
only
oh,
gonna be
sure,
90, yeah.
11%, how many points?
This one is 2.5 points.
Okay, and the way the fund works, how much does the fund get?
The fund's going to get half of those 2.5 points. So
But all of the 11%.
all of the interest, yeah, all of that note rate goes to the benefit of the shareholders of the fund, and then the way our fund is designed, the fund profits from short-term flip loans because we're putting half of the origination points from every loan also into the fund for the benefit of the shareholders. And the reason for that is because that way, if we can lend the same dollar out 2 to 3 times per year, those additional origination
That
points
enhances the
will help
yield,
enhance
sure.
the yield. That helps us deliver that 8 to 9%
Okay, well, let's
yield.
get into this Oakland Hills one for just a minute.
Yeah.
It's 95% done, so
Yeah.
that needs another $20,000
Yeah,
or something.
he's got a budget of about $25,000 to
So
finish the property.
you're not lending that to him?
No.
No, he's coming
He
in
has
with
that money in his
plus
pocket,
he's
yeah.
coming in with the 30% of the
30% of the
purchase
420.
of the 420.
Yeah.
Okay, so you're
A little over
lending him
120,000.
280,000 or something like that.
Yeah, I think it's 294.
294. So you're lending 294 in today's condition, and he's going to enhance the property because he's going to finish it.
We think our exposure is about 50% loan to market value once it's completed.
So in a sense, in kind of a funny sense here, you in theory might hope he doesn't pay because then you can actually make a lot of money by foreclosing.
Well, and that's exactly, that is an accurate point, although we generally don't take that
You're
position.
too nice a guy.
And it doesn't happen. It's not happening in this
Yeah,
market.
because this guy, I mean, if he runs into trouble, he'll sell it himself for
He'll-
$500,000.
Or he'll find another source of equity,
Another-
a partner
another
or
hard money
something,
lender,
another hard
probably.
money lender. I mean, you're right. This
Okay.
property is going to be completed shortly. It's going to be put on the market, probably sometime in December, or maybe after the first of the year, after the
So
holidays.
in this case, the reason he couldn't go to the bank was because
The property's not complete.
Not
Bank won't
complete.
lend on it. It's not a bank financeable transaction.
95% done and the bank won't lend on it.
Absolutely not. They're not allowed to. It doesn't meet their conditions. It's not habitable. There's not a notice of completion. I mean, it's habitable,
Yeah.
but there isn't a notice of completion.
Okay,
from
and
the
so
city of Oakland.
I'm just sort of thinking. I'm trying to be devil's advocate here. So, if this guy, let's say tomorrow, he gets hit by a bus or he takes off the country, not only is he going to lose his down payment, and that 20,000. Let's assume he stole that. I mean, not stole it, but he didn't put it into the property. I guess in theory, you could come up with the other 20,000 and finish the house.
Oh, absolutely. One of the factors of our business is that, well, me personally, I have 30 years experience in real estate, and I worked the first 20 years in my real estate professional career for a developer. I mean, I know what to do, how to finish this property.
You carry a hammer with you.
I personally buy fix and flip property. It's not my major. It's I'd be a fool not to have a little sideline real estate investing going on in addition to other
But
activities.
that's not competing with your partner in
No,
own
gosh,
business.
no. What I've done is some of my rehabber clients, or one actually in particular that has borrowed from me repeatedly, and I like him very much. I've thrown in some capital into an LLC, and he's actually the guy that goes around and buys fix and
Okay,
flips.
just
So I'm not doing it. It has nothing to do with Pacific Private Money, but it's just that's how I choose to invest some of my personal profits. I like to eat my own dog food, I guess. So to speak.
Okay, and just to remind the audience here, because I'm sure they're listening and going, I want to earn 8, 9, 10%
Who are these
interest.
guys?
Okay, you're listening to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. How do people get a hold of Pacific Private Money?
They call our phone number, which is 415-883-2150. Go ahead and call this weekend and leave a message for us, 415-883-2150. Check out our new website. It just went live. It's still in semi-beta form, but it's the Pacific Private Money Fund's new website at pacificmoneyfund.com. That's pacificmoneyfund.com. We also have our broker website, which is pacificprivatemoney.com. I know that don't want to confuse the audience, but we've got a number of Pacific-related websites. So either pacificmoneyfund.com for information on our mortgage pool fund, or go to Pacific Private Money to learn more about our brokerage, and if you want to borrow money as a real estate investor and learn more how you can get money fast and easy, generally speaking, at least compared to banks.
Yeah,
a lot easier than a
sure.
bank loan. That's the other reason why people come to us for bank financing. Also, before I forgot, we did do the fund launch party last night, and so for those of you listening who were unable to attend, and you would like to see a copy of the PowerPoint presentation, which gives a lot of detail about how the Pacific Private Money Fund works and how it delivers an 8 to 9% yield, go ahead and send me an email, and I'll shoot you a PDF version of that PowerPoint slide presentation on the Pacific Private Money Fund. So send me an email to mark@pacificprivatemoney.com. That's mark@pacificprivatemoney.com. And if you can't remember that because you're driving and you don't have anything to write down with, just Google when you get home Pacific Private Money, and numerous links will pop up to our website. And once you get to our website, it's easy to find our email address there again because we're very transparent, easy to get a hold of.
And we have all of previous shows on the website, Mortgage Investing 101.
That's right. I was remiss. MortgageInvesting101.com, the radio show website, has podcasts of all our previous shows. So if you caught just maybe a snippet of this show and you want to hear, a show from start to finish where we pretty much go through the
Nuts and bolts.
the nuts and bolts of mortgage investing and mortgage-backed investments, the last 15 shows are there for your convenience to listen in podcast form on your iPod or iPhone.
All right, well, we're going to have to cut out now. So tune in next. I know.
Just starting out fun.
We can do this for another 3 hours. Tune in next week to Mortgage Investing 101. We're going to be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing. Thanks for listening. I'm your host, Edward Brown. And on behalf of Mortgage Investing 101, so long. We'll catch you next week.